The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, folks, good afternoon. The first chart that I posted into Tiger TV today is a request from Basil Chapman. He wanted to see the correlation between the stocks, which I put up the cash S&P weekly chart, going back to 2006 versus the 30-year Treasury bond. And basically you can see here that there are periods of correlation, but there are also periods of correlation where it doesn't really happen. For instance, during 2007, if you would have been long bonds and short stocks, you would have made a great deal of money. But then after 2009, when the QE2 began to form itself, bonds and stocks went up together, which is unusual too. But I think the only way you can handle it is to look at each entity separately, because they're separate, and different types of investors, buy different types of instruments. Now, the bond market is at a minimum of 6 times bigger than the stock markets. I mean, it's just a minimum, and that's just the smaller market, because the note market, the Treasury notes, the paper that is 10 years to 2 years, that's even far bigger than the 30-year bond. I think because where we are right now, we're going to spend the first part of this show today going over where we are in the interest rate market, because I believe we've come to one of those points that really deserves our attention. And the first thing I wanted to do was to go back into history a little bit and show you where we were 2.5 years ago, when the Treasury bonds were making the big butterfly pattern. That was the old "I'll ride the boat" trade, and the little joke between Tom O'Brien and I is Tom thought they were going to get to 160, and I said, if they get to 160, I said, I'll take a ride in one of your yachts. And we never got there, thank God. I would have had to renege on him because I don't like boats. But anyway, that's what we're looking at. If you take a look at this pattern, I mean, it goes back 6 years. When it made the top up here at that 154 level, it was completing an ABCD pattern, which is known as the butterfly pattern. And it's a very, very powerful pattern, especially when it's on a weekly basis. And as you can see now where we are making a 61% retracement of the high we made back last year in May, and we're also at a 50% level from where we were in 2012. So we're at a very, very critical level here in the Treasury bonds. But I think as we go through the rest of these charts that we have here this morning, I think you'll see that there's a lot of things that are telling us that we really are at the proverbial moment of truth. Now, I wanted to, just for a minute, just to show you that same pattern in a totally different market, because it's a very large market, and it is the third largest economy in the world, Germany, and I wanted to show you their Treasury bond and let you see it, and you'll notice that it's making that same type of pattern that we had in our market back in 2012. So interest rates in Germany have dropped even more than they were back in 2012, where our rates here have actually gone a little bit higher on a comparable basis. I think the 10-year note, in fact, I'm sure the 10-year note for the German note, it runs at about 0.88, and we're about 1.8 in our on our 10-year we're about 2.3, and so you can see the difference here is a great deal in the two numbers, and that's primarily probably why their euros getting smacked so hard, because nobody wants to hold euros. They would rather hold dollars in Treasury bonds or Treasury notes, where they get that 1.5% edge. Whether that's true or not, I'm not sure. I'm just saying that's a possibility. Now, if we took a look at the bonds where they're standing. Now what we need to do is we need to go and take a look at the largest market of all, and that is the Treasury note market. That's the 10-year note, and that's known as that's the interest rate for your cars, your credit cards, all that stuff. And just to put bonds in instead, just a second here. I wanted to show you here because this is a very, very interesting phenomenon that we have going. By the way, we switched over to the December contract today. I'm going to still be showing the September because it's at such a perfect level, and I wanted to let you see this because this is a very, very big divergence, folks, because this is a huge market, and it really is it's really something special what we have happening here. Now, when you take a look at this, you're going to see that today's high, looking at this hourly chart on the 10-year note, was at the 61% retracement of where we were 2 weeks ago. However, when you look at the Treasury bond market, we were making the ABCD pattern, making higher highs. So the short-term rates were going higher and longer-term rates were going lower. That's a very unusual occurrence of what's happening, but that's usually very, very significant. That usually means that rates follow the 10-year more than they follow the 30-year because it's the much larger market. Now, if we go and we take a look at that Treasury bond on a little bit shorter term basis, looking at the daily instead of looking at the weekly pattern, we're going to see that we're going to come up with a really nice area where we're coming up to the ABCD patterns that we were just talking about. These are the longer term ones. All I'm doing now is just drawing these in so that you can see, where we are on a little bit longer term basis. This will be the 30-year bond if I can get this thing to come over here. There we are. Just 1 second here, and then we'll be all right. Yeah, we're okay. I think this will show up because I really want to show the ABCD pattern from going back the last 6 months. That's what I'm really trying to show you, that we're completing this big pattern in the Treasury bonds. And believe me, folks, I don't know diddly squat about the fundamentals behind this. I really don't. All I know is that you've got two of these coming together. You have a 3-drive pattern coming in here. You have divergence where the Treasury notes are trading at the 61% retracement of where we were 2 weeks ago in the bonds, and that's the big market. I mean, you can't manipulate those Treasury notes. That's just too big a market. And so it's really important. Whether it's going to mean anything or not, remains to be seen. All I know is if interest rates, start to go lower, that means these bonds are going to go higher, and notes are also going to go higher, and that would mean that the rates would start to go lower. But the way it's looking now, rates turned 2 weeks ago, but we're making a higher high in bonds today by about 8 ticks from where we were 2 weeks ago. And we're only making a 61% retracement in the Treasury note market. That's telling you that interest rates look like they're going to go higher. Now, the first chart that I posted in here today was the correlation between the stocks and bonds. And, folks, if you try to do a correlation between stocks and bonds, you better be very careful because there's periods there of 2 and 3 years and sometimes longer where there's not much correlation at all. I mean, remember 2012, stocks kept going up for 2 more years. They went from 2012 into where we are now, and bonds had a huge correction. We just had this last 4 or 5 months, 6 months, where the market has, rallied back, to a 61% retracement. But, that's not a good way to do it. You're going to be losing a lot if you just did the straight, short bonds, long stocks or something like that, because that's not a good way to do it. I think you have to look at each pattern separately. Each entity is a different asset class, just like the gold-silver spread can go, absolutely wacko at times, and you don't want to get involved, with something like that. So I think it's, quite important to keep in mind that this is something that, needs to be looked at from a pretty good perspective. Now, the next one I wanted to show you, because I know a lot of you folks follow the TLT, and I'm going to put that chart in here because we are making a 786 retracement. We're trading there right now at 119.17. We're completing a 3-drive pattern over the past 3 months that started back in May. And as you can see, it's spot on. I mean, this is at the moment of truth. I mean, you're looking at everything coming together. It's either today or tomorrow. And tomorrow, remember, is the last day of the month and the day before a holiday, which means the stock market has a better than 70% chance of closing higher tomorrow. There's three main reasons. One is the holiday influence. A day before a holiday has a 75% chance of the market closing higher. It's going to be an up week in a Friday in an up week, which is number 2, and it's going to be Friday in an up month, which is number 3. When you add those together, it's going to be really difficult for the stock market to close lower tomorrow. Now, maybe it closes a little bit higher, a little bit lower. We don't know because the trading volume is a fraction of what it should be because of the holidays. But those are the odds. Now, coming in to the 2nd of September, when we come in, we've got a lot of things happening cycle-wise. I don't know if you folks know who Martin Armstrong is, but he runs Armstrong Economics, and he's been a very colorful figure in finance for many, many years. He spent time in jail because he wouldn't give government information that he thought they shouldn't have, and he finally was released after not even having a trial, or they kept him without bond or everything. It's just a horrible situation, but he's back, and he's got some, he's one of the best cycle people in the business. And he's calling for September 2nd, September 3rd to be a correction in the stock market. Not a top of major proportions, but he thinks there will be a correction starting around September 2nd, which is the day after the holiday. Whether that happens to be or not, I don't know. I was fortunate enough to meet Martin Armstrong back in 1988. My book had made the book of the year, The Astro Cycles, A Trader's Viewpoint, and I was asked by the Foundation for the Study of Cycles that was owned by Tudor Jones at the time. They opened their new office in Orange County, and I was going to give a presentation there on astrology because Edwin Dewey from the Foundation of the Study of Cycles had done a lot of work in the 40s and 50s, and we had Paul Volcker was there, Martin Armstrong was there, and I happened to meet Martin Armstrong, and I spoke with him for a little bit, and then I was talking to somebody else. This lovely young girl came up, and she said, well, what did you think of Mr. Armstrong? And I said, without doubt, he's probably the most arrogant person I've ever met in this business. And she laughed, and she said, I think about that all the time. And I said, why, do you know him? She said, oh, I'm his fiancée. Never did get over that one. Anyway, he laughed about it, but that's the way it is. But he does have a very strong opinion of himself, but like Muhammad Ali says, if you can do it, it ain't bragging. Okay, folks, we got the Dow coming back strong. Treasury bonds still up on the day, and gold is selling off from its high.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Andy Hecht's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
Okay, we're back, folks, and I wanted to talk just a little bit about the German stock market because we talked about it yesterday. We hit the exact 61% retracement yesterday, up around the 9,600. The market broke 200 points into the low of today, which came in around 94.10, and that was an exact 61% retracement of last Friday's low. So, that's very, very strong support that it hit. So it's going to be very interesting, what happens from here, because we did hit that exact 618% retracement yesterday with the DAX, and we did stop exactly where it should have today. It's just amazing how this trading vehicle works, because it just really follows the Fibonacci numbers, far better than we have with the S&P. Or the NASDAQ or the Dow, in my opinion. They follow pretty well, but it's better that they follow this with the other way that we're looking. As a matter of fact, we're making a 61% retracement in the S&P futures around the 1997 level from the high we made at 203. So this is going to be an interesting spot to see if the market's going to hold that level or not. This will be what we're watching. But like I said, it's going to be really hard for this market to be down tomorrow, maybe even today, because you've had a situation where you've got all those positive things going that makes it really interesting to make a spot for it to to bounce from. And, it doesn't take much to bounce because we've been high, ever since August the 14th. Well, actually August the 7th without any trouble at all. So this is what we're watching here in the stocks. Now let's get to the commodities. Now the one that we were looking at, there were several yesterday we were looking at, of course. One was the silver market because we were setting right at that 61% retracement. I want to bring that chart up here to show you what's happened with that so far because we had a really strong move this morning. We backed off well over 20 cents from our high already, which it's not a very good sign of bullishness from the sign of silver, but we did hit the exact 786 retracement for 4 days in a row. Down at that 1930 level, and today's high we got up to 1987 and a half. So it rallied, well over $2,500 in just a really short period of time. And see, that's 30 cents. Yeah, that's right. They're at $2,500, and now it's backed off quite a bit of that. Move. Let's see if it's backed off. No, it's just coming back to 61% of that move from the low yesterday. I'll put this in here and let you take a look at it. That's exactly where we are now. So there should be pretty strong support here in the silver at the 1950 level. Because that's all it's doing now is just, backing and filling as it moves up, through the food chain of these precious metals. The gold has held up pretty well off of the 786 that we looked at yesterday. At the 1282, it got up to 1297 in a sense, backed off quite a bit. But the one that I'm really keeping an eye on because it still looks pretty healthy to me, and that is the XAU, because we've tested this, and this is the gold and silver stocks, folks. These are the mining stocks themselves, and this has held this level of there we go. It's held this level for several months now. We've been at the exact 382 level, down around $98. Our low earlier this week, we got down to the 98.08, and so we've been above the 382 level now for 3 months. That's from the low we made back in May. So if we've got a chance here in gold and silver, it's getting ready to let us know, because this gold and silver index is still the most bullish of anything in the complex because of the way that it hasn't backed off. And it's at a very strong level of consolidation here since early July. And here we are coming into September, July, August. So we've had 2 full months of consolidation. And, boy, if we ever get above 106, another 6% higher in this thing could really go, because it's had a great deal of consolidation at that 382 level. This is equivalent to what, on a chart pattern, is what we did with the Japanese yen when it first took off from 75. If you'll remember that, when Tom O'Brien was talking about King Dollar and going long the yen at 75, and it took off. Well, this is the same type of pattern that we're looking at. Okay, folks, we'll take a little break here, and we'll be back after the break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, folks, I've posted into Tiger TV the ETF for the high-yield bond market. That's also known as the junk bond market. The symbol is JNK. There's another one called HYG, but they pretty much look exactly the same. We hit that 61% retracement back on in late July, early August, and from there we've had this really strong rally that so far has stopped at the 786 yesterday. Now that goes along with what I'm looking at, in the bonds and the notes to see if this market is going to, this interest rate market is getting ready to turn over. The notes are telling me that that's what's happening, but the bonds have yet, to do that. And the notes is by far the largest, of all the commodity markets, that we trade at all. Now we need to take a little bit of a look here at the soybeans that we were watching yesterday. We had we were watching them down around that 786 level. Fortunately today, they had a pretty good rally. We didn't get stopped out, and it rallied up to the 786. We had a really strong rally. In fact, the rally was well over over 13 cents, which for soybeans makes it a major bull market anymore because it's been so bearish. So what we're doing now is we're raising our stop to our break-even point here in the soybeans so that we don't have anything to risk. And the market really has to move really strongly in our favor here either today or tomorrow, because if it's anywhere near our buy price down at 10.25, we will not hold that over a weekend because you don't really want to face a gap. Because if you remember last Friday, the market closed in beans, and then on Monday it opened sharply lower, dropping another 12 or dropped another 20 cents. So you don't want to step into that. That's one of the advantages of these markets, because our commissions are so low that you don't really have to take the overnight risk in anything, whether it's stock indices, bonds, currencies, or whatever it happens to be. You can always enter sometime either Sunday night or early Monday morning, to put your position back in and protect yourself, because protection is what, this is all about. We don't know which ones are going to work and which ones are not going to work, but we do know that we can control our risk, and that's what we're really, really looking to do. Now, there's another one of the grain markets that we need to cover again, and that is the corn market, because, they have so much corn they don't even know where they're going to put it. And so corn is actually held up a little bit here. It did not make a new low than yesterday, whereas we did in the beans. And so it's still in an area where it has a chance to rally a little bit. But frankly, this is a very, very bearish market, and any rally of 20 or 30 cents would certainly be a spot to look to go short. There's only one hope that I see. Well, there's two hopes, I guess. The first hope is that if they get an early freeze, that would be sometime in September. If they got a really hard freeze across the Midwest, that would really hurt the corn crop, and to get it down to manageable levels, and then you could see a tremendous rally in corn, maybe even $1 a bushel, which is $5,000. But remember, it came from $6.50 down to $3.50, so it dropped $15,000. So a rally back of $1 a bushel would only be, a 3.82 retracement of that whole thing. So, we should thank our good friend Rich Anderson of Anderson Capital Management to alert us about the corn and the beans. When the beans were back at 12.42, he was, very, very bearish. And at that time, it happened to be forming a beautiful Gartley pattern for a sell signal. And, of course, the beans, fell very, very dramatically over the next 5 weeks. Now, whether this is going to be a significant bottom or not, I'm not sure, but we've seen the 3 drive to a bottom pattern in the soybeans hold so far at the 10.19 per bushel level, but it really needs to get above 10.45 in order to get any type of a rally going, and that's what it is. It's just a tradable rally. That's all you're really looking at. There's nothing any more than that of what we're looking at. So just keep that in mind. Someone asked a question about the TBT. That's the reversal. That's the ETF for being short Treasury bonds. And, of course, that one is going down, gap down again today. And I don't really do that ETF. I don't even do the TLT. It just happens that the TLT, someone asked me to post it, and so I did, because it's so much easier to trade the bonds and the notes because, you get better leverage, better execution, and more volatility. And so those are the things that you really need in order to try to take some money out of the market, whereas ETF it's okay if you can only trade that because of your requirements in your 401k or whatever it happens to be, but those should be for longer term trades. You shouldn't even think of them for more than 3 or 4 days. They should be looked at for several weeks at a time, and that's why they look interesting right now, because we got that TLT trading at that 119.17 level, which is the 786 retracement of this move, and that's why I believe that it looks so important from a technical standpoint. Someone has asked me a question about the reason I get these by email, by the way. Sometimes I get them in the Tiger's Den, and once in a while by Skype. But they asked me about having Arch Crawford back on the show. I will in a few weeks. I'm trying my best to get Mark Douglas on the show early next week. I'm going to be visiting him over the Labor Day holiday, and I'm hoping to have him on next week. He's finishing his book that is really a masterpiece, in my opinion, and he can talk about that a little bit and also give us some ideas about, how to handle, some of the problems that you have, with trading, taking your profits too soon, getting out too soon, waiting too long. I mean, just all the things that can happen. And most of them are related to not having a trading plan, and also by looking at the monitor all the time, because the monitor is not your friend, folks. The monitor is your mortal enemy. It really is, because when you're looking at that, it's flashing back like a mirror all of the psychological imperfections that you have, whatever they are, whether it's related to your family or your parents, your grandparents, whatever it could be, your children. It doesn't make any difference. Those will be reflected back. That's why when people watch the market and they're long, they focus on the upticks, and when they're short, they focus on the downticks. And the reason for that is that's a pleasurable feeling. Whereas if you're long and the market's going down, that's not a pleasurable feeling. And our bodies are, programmed to, stay away from pain. So that's why we do that. So it's not really good to even look at the monitors. Mine are set to turn off in every 15 minutes. So, if the alert goes on, then I'll be able to take a look at it and see what's happening. But that's literally just what's going on. So we'll see. We got a caller from Bob in Connecticut. Are you there, Bob?
Yes, I sure am. Thank you, Larry.
What can I help you with?
I really enjoy your the Bradley model. Had a question about the Bradley model.
Yes, sir.
Very impressive track record. Outperformed the Dow in the last 16 years from what I could figure out last night. My question is, it's been tough fighting the Fed and looking at being a bear in this market. But when was the last time the Bradley model failed or gave a false signal? Are we overdue for a false signal, or has there been, in the last 20 years or so?
Oh, that happens all the time. If you look at it, it caught the high perfectly, in early July. I'm going to put it up here so folks can look at it. But the thing to watch is the key Bradley dates is when you what I'm going to do is give me 1 second to mark this, and I'm going to put these on the chart so you can see the Bradley dates, and you'll see what happened at the time, and you'll see that they were really quite accurate, and that's what gives you the statistics that you really need. But the overall trend, is still okay, but you can't trade against some of these wild swings that we have. Now, what I'm going to do, Bob, is I'm going to put this chart up here of the Bradley model going back to last December, and you'll see the three red circles that I drew. It. One came in on January, right around January 1st. You see the market was making a high, and the Bradley market was making a low. That's known as an inversion because it's doing the exact opposite on the key Bradley date. Instead of going down, it was going straight up. And then again, if you look at it in early February, it was doing the exact opposite again. It was coming straight down when Bradley said it should be going up. And if you look at those, the key dates, along with the overall trend, that's what you really want to be watching. Now, with this model that we have right now, since we topped in July, we went up and we've made a double top in the Dow so far. We took out the high of July 3rd. But the key here is we did the same thing in October of 2007. And on October the 14th, we topped on a new moon, and the market had made a slightly higher high than we did in September, and then the market gave, better.
Larry, 50%. Can I interrupt you a second? Oh, there it comes.
Please, yes.
Yeah, it wasn't coming through on Tiger TV, even with the delay. So now I got a clear picture. Okay. I can actually see the truth.
I don't even know what the delay is or anything like that. I'm such a technical bozo. I guess that's the best description I can get. But my little 3-year-old grandson, Bob, can actually take his dad's iPhone and go to Facebook and pull up his pictures and his YouTube things. He's 3 years old. I mean, it's just amazing that they can do these things. I just don't understand it. But the world has passed me by, but I had a nice ride with it because been on this planet for a long time. So things have sure changed.
Well, your experience and everything is very much appreciated. Well, yes, it did. Thank you.
Well, thanks. I know the experience part has been, part of it. I remember the days, the really, really big days in the market, October of '87 and March of '09 and stuff like that. Those, major ones. But there have been some fun ones in between, too. But it's just a matter of probabilities. I thank God that He gave me something to do that I love to do, that I can still, do it every day, and I'd rather do this than do anything because I'm really not working. I'm having fun, and that's the whole beauty of it. Confucius said, if you do a job that you really love, you're on vacation for the rest of your life, and that's pretty much what I've been doing for all this time. Sometimes I should take more Yeah, it's far better than boating, that's for sure. Okay.
Hey, I got a follow-up question.
Sure. Go right ahead, Bob.
It's more of a scenario-based question. If we do get a sharp sell-off in the Dow and the S&P in the next couple of weeks, and as a result, interest rates actually go further down than they are now, won't that, and the flight to quality plus the lower interest rates, wouldn't that make gold and silver pop up in the next few weeks?
I don't think so, because there's virtually no correlation between those. I did the correlation on the bonds and the stocks, and you can do the correlation, with interest rates and gold, and you don't see that very much. Back years ago when I was at Drexel, and during the 70s, from 76 through 82, interest rates were going to 13% in T-bills, and that made the carry charges on the futures contract unbelievable. You would have to pay 10, 15, or even 20% more on a contract just because of the fact that the carrying charges were so high. When gold hit its high on January 20th at 865 back in 1990, spot gold was at 865. December gold, this was January, and in December gold, just 11 months out, was selling for over $1,000 an ounce just because of the carrying charges related to the interest rates, because interest rates were so high. Because I sold Christmas gold above $1,000 an ounce that day, and it was it was a great trade, but I didn't stay in it long enough. But I remember selling it over $1,000 an ounce, and I never thought I'd ever get there, but it did.
Very good. Thanks so much, Larry. I really appreciate it. You're one of my heroes.
Oh boy, you're in big trouble. Thank you so much. I like those kind words. I really do. I don't know if you mean them or not, but I hope that you do, because they makes me feel good. It takes away from some of the the spoiled vegetables that people deliver to the house here every day, but I give those to the rabbits, so it's not a big deal,
I liked your story about the guy you made $1 million for, and he took his business elsewhere.
It was actually closer to $2 million, and but anyway, that's who knows what that's going to do. What I'm going to do here for you is I'm going to take a look here on this relationship between the bonds. Oh dear, it didn't come up. We're going to have to take a break here. Oh, you know what happened? I did it wrong. Stay with me here, Bob. And when the break comes, just stay with me, because what I want to do is I want to put the bonds over the gold so you can see if there's any correlation here at all. And we'll take a look at that right now after the break, okay?
Okay.
All right, stay with me. Yeah, stay with me, you bet.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN. Now, back to the Futures Hour.
Okay, we were talking with Bob in Connecticut, and I've posted the gold and the Treasury bonds overlaid going back over the last 7 years, and you can see, that during long term there have been some very good correlations. The last year has not been very good, but this long term it's been relatively good. Now whether that's because of just an asset class, I'm not sure, but I trade each one of them separately, so it really doesn't involve what I'm doing. If you're interested in intermarket spreads, you should get John Murphy's book on intermarket spreads, because he really understands that stuff very, very, very well. That's John Murphy, and I think
I read his book. It's great. Yeah.
Yeah, he's very, very good. And he's a really nice guy, too. So he answers questions if you have them, but it's certainly good. So I hope that helps.
Yes. If you have time, I had a follow-up. In the DAX, the 60-minute chart that you posted earlier, I think I was beginning to see a formation of a head and shoulders. Do you see that?
It hasn't formed yet, but it could over the next couple of days. Yes, you are correct. Huh?
All right, Larry, I'm going to hang up. Thanks so much.
Okay, you bet. We have a question from our friend in Philadelphia, Mr. Z, and he asked about the market back in 1970 through 1973. The Dow had assaulted the 1,000 level for several years. We had gone from after Kennedy was assassinated, we had rallied up into 1970 during the Vietnam War, and the market had hit 1,000 to 1,060 about 3 or 4 times over the past few years, and then it topped in late 73 and came all the way back and made a 61% retracement of the low from 1962. And that happened in October of 1974. That was the big low. The Dow was trading at around 500, as I recall, because we'd been around 1,000. We didn't have S&P futures. We didn't have NASDAQ futures. None of that stuff. Well, NASDAQ futures had just been born, but they weren't not futures, but the NASDAQ had been born, but they didn't even have an index for it. It was basically just stocks traded on the NASDAQ. But then after that, it took until 1982, when late 82, early 83, when we finally broke above 1,000, and then it took off. Now, where we are at 2,000 in the S&P now that we posted yesterday, that's the very big ABCD from 1982. That was August the 9th, 1982, and that's when Volcker dropped interest rates. And raised interest rates dramatically, and that's when the stock market bottomed and made a big ABCD, and that completed from 2000 and then down to 2009. Well, you could use 2007 and then 2009, either one of them. They're both pretty much the same price, and that ABCD measures to 2001, and we hit 2002, so we're pretty much spot on if that's the big ABCD. The Dow has made a higher high. The NASDAQ has made a higher high. The New York Stock Exchange Index has not made a higher high. The Russell has only made a 61% retracement. There's some divergences. The transportation has not made a new high. The Dow Jones Utility has not made a new high. So whether this means anything or not, I'm not sure. But if we make a new high in the New York Stock Exchange Index, the Bradley model is certainly going to be wrong. And that means we'll be looking at several more months of sunny weather on the stock market, the way it looks like. But there's some ominous winds out there. I feel them in my bones, folks. I know it's a feeling, but when you've been around a long time, you sort of get that sixth sense that there's something foreboding. Live every day in an attitude of gratitude, and may God bless. And your homework for today is do something nice for someone who doesn't have as much as you today, folks. May God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.